It's 5:42 a.m. Eastern, January 23, 2026. And 22 days ago, while Americans were celebrating Christmas, China pulled the trigger on what could be the single most important commodities policy decision of the decade. On January 1st, 2026, while you were nursing a New Year's hangover, China implemented the most restrictive silver export controls in modern history. Not a gradual phase-in, not a soft approach, a complete restructuring of who can export silver from the world's largest silver refining nation. And the financial media? They buried it on page 17 next to stories about holiday shopping trends. Here's what the screens are showing you right now. Silver spot price, $90.88, up 0.1% on the day. Gold, $4,615.22. The gold to silver ratio, 50.8 to 1. Just another quiet morning in precious metals. The screen is lying to you. Because what China just did, what took effect 22 days ago, has created a ticking time bomb in the global silver market that most investors don't even know exists yet. Let me be very clear about what I'm claiming here. China didn't technically ban silver exports. That would be too obvious, too aggressive. What they did is far more insidious. They created licensing requirements so restrictive that they've effectively eliminated 95% of Chinese silver exporters overnight. Here are the new rules that took effect January 1st, 2026. Requirement number 1, companies must produce a minimum of 80 tons of silver annually to qualify for an export license. That's 2.57 million ounces per year. Most small and mid-sized Chinese refiners produce 20 to 40 tons. They're now locked out. Requirement number 2, companies must maintain $30 million in credit lines with Chinese banks. This eliminates smaller operations that don't have access to that kind of capital. Requirement number 3, companies must receive government approval for every single export shipment. No automatic licensing, no streamlined process, bureaucratic review for every transaction. The result? Only 44 companies in all of China are now legally allowed to export silver, down from hundreds of exporters before January 1st. And here's the part that should terrify you. China accounts for 60% to 70% of the world's refined silver output. Not mine production, refining capacity. They take raw silver from Mexico, Peru, Australia, refine it to investment-grade purity, and ship it globally. When you control 70% of global refining and you restrict 95% of your exporters, you've just created a global supply choke point that cannot be fixed quickly. Stop. Let that sink in for a second. 70% of refined silver, 44 approved exporters, government approval required for every shipment, and it gets worse. On December 26, 2025, 6 days before the export controls took effect, Elon Musk publicly warned about what was coming. At 10:05 p.m. on December 26th, responding to a post about China's export restrictions, Musk tweeted, "This is not good. Silver is needed in many industrial processes." That wasn't a casual observation. That was Elon Musk, CEO of Tesla, the world's largest EV manufacturer, telling his 200 million followers that his supply chain is about to break. And on the exact day China's export controls took effect, January 1st, 2026, silver was trading at $83.90 per ounce, a then all-time high. The market was already pricing in the supply shock before the restrictions even started. Today, 22 days later, silver is at $91. That's an 8.5% gain in 3 weeks. But here's what matters. That's just the beginning, because the physical supply crunch hasn't even started showing up in industrial procurement yet. Let me walk you through exactly what China just did and why it's about to create the most violent supply squeeze in modern commodities history. First, understand what refining capacity actually means in the silver market. Most silver doesn't come from primary silver mines. Approximately 70% of global silver production comes as a byproduct of mining other metals: lead, zinc, copper, gold. Miners extract mixed ore, separate the metals, and ship raw silver concentrate to refineries. Those refineries take the impure concentrate, maybe 90% to 95% silver, and refine it to 99.9% purity, also called 4/9 silver. That's the standard required for industrial use, investment bars, and exchange-traded products. And China dominates global refining capacity. According to industry data, China processes approximately 3,300 metric tons of refined silver annually. That's 106 million ounces. For context, total global silver demand in 2025 was 1.05 billion ounces. China's refining capacity represents 10% of total global consumption. That's not a small player. That's a critical choke point. Now let me show you the math on what happens when you restrict 95% of that refining capacity from exporting. Before January 1st, hundreds of Chinese refiners could freely export silver. Small operations processing 10 to 20 tons annually, mid-sized facilities doing 40 to 60 tons. They collectively represented a significant portion of global supply flexibility. Under the new rules, only companies producing 80-plus tons annually with $30 million in credit can export. That eliminated most small and mid-sized operators overnight. Let me give you an analogy that makes this crystal clear. Imagine you're trying to fill your car with gas. Normally, there are 100 gas stations in your city. Some are big chains with 20 pumps. Some are small independent stations with 2 pumps. But collectively, they can serve everyone. Now imagine the government passes a law. Only gas stations with 15-plus pumps and $30 million in capital can sell fuel. Suddenly, 95 of those 100 stations shut down overnight. You're left with 5 big stations trying to serve the entire city. What happens? Lines form, wait times spike, prices surge, and some people just can't get gas at all. That's the silver market right now, and industrial buyers are starting to panic. Here's the proof. Between December 20th, 2025 and January 10th, 2026, the 3-week window around the export controls taking effect, silver lease rates spiked from 0.8% to 4.2% annualized. What are lease rates? They're the cost to borrow physical silver for short-term delivery. When lease rates spike 425% in 3 weeks, it means physical metal is becoming scarce and industrial users are desperate. Now let me show you why this matters specifically for U.S. manufacturers. The United States imports approximately 5,000 metric tons of refined silver annually. That's 160 million ounces. A significant portion of that comes from Chinese refiners who process raw concentrates from Latin American mines. But now those Chinese refiners can't export without government approval. And when approval does come through, it's slow. Shipments are delayed. Lead times extend from 2 weeks to 6 weeks to 12 weeks. And here's the industrial panic mechanism. When manufacturers can't reliably source silver, they panic hoard. Tesla needs 2.16 million ounces annually for EV production, 25 to 50 grams per vehicle times 1.8 million vehicles. Solar panel manufacturers need 140 million ounces annually, and that number is growing 15% per year as solar installations accelerate. Semiconductor fabs, 5G infrastructure, AI data centers, they all need silver, and they all need it on schedule. Production lines don't stop. Assembly doesn't pause. You either have the metal or your factory shuts down. So what happens when procurement teams hear that Chinese exports are restricted? They order double or triple their normal amounts. They build strategic reserves. They lock in supply contracts at any price. That removes metal from the market permanently. And in a market already running a 200 million ounce annual deficit for 5 consecutive years, panic hoarding accelerates the squeeze exponentially. Let me show you the supply-demand math that explains why this is unsustainable. Global silver production in 2025, 850 million ounces global silver demand in 2025, 1.05 billion ounces annual deficit, 200 million ounces. That deficit gets filled by drawing down above-ground stockpiles, but those stockpiles are running dry. Comex registered inventory, down to 38 million ounces, from 120 million in 2020. London vaults, drawing down steadily. Shanghai vaults, being reserved for domestic Chinese use. And now, with China restricting exports, the cushion is gone. There's no safety valve. There's no release mechanism when demand spikes. Here's what Elon Musk saw that made him tweet his warning on December 26th. Tesla's procurement team had been monitoring China's export licensing proposals since November. They knew the January 1st deadline was coming, and they started calling Chinese suppliers in mid-December asking, "Can you still ship to us after January 1st?" The answers they got back were variations of, "We don't know. We're waiting for government approval. Lead times are extending. We may need to prioritize domestic orders." That's when Musk realized Tesla's silver supply chain is compromised. And if Tesla, with all its capital, all its leverage, all its supplier relationships, is struggling, what does that mean for smaller manufacturers? It means the industrial supply crunch is real, and it's accelerating. Now let me show you the geopolitical layer that makes this even more dangerous. China didn't implement these export controls randomly. This is part of a broader strategic minerals policy that includes rare earths, gallium, germanium, and now silver. The goal is simple: prioritize domestic industrial development while controlling global supply to maintain leverage over Western manufacturers. And it's working. According to analyst Anton Karatanov, if China applies these export rules strictly, silver prices could rise 30% over the next 12 months. That would put silver at $118 per ounce by January 2027. But here's what Karitanov's missing. The panic buying hasn't even started yet. Industrial procurement teams are still in the assess the situation phase. When they move to the secure supply at any cost phase, prices won't rise 30%. They'll gap 50% or more in a matter of weeks. Now let me tell you what the mainstream financial media won't report. Why this story is getting buried while they run 24/7 coverage of stock market all-time highs. Because if retail investors understand what China just did, the paper silver market collapses. Here's the dirty secret. The global silver market has been operating on a fractional reserve system for decades. For every 1 ounce of physical silver in vaults, there are an estimated 356 ounces of paper claims against that metal. Those paper claims come from futures contracts, unallocated storage agreements, and synthetic ETF products. The system works as long as most participants settle in cash instead of demanding physical delivery. But when industrial users can't source metal through normal channels, when Chinese exports are restricted, when lead times extend to 12 weeks, when suppliers say, "We don't know if we can deliver," those industrial buyers start demanding physical delivery on their paper contracts. And when physical delivery demand spikes in a fractional reserve system, the whole structure collapses. Let me show you exactly how this plays out. Right now, according to commodities analyst Rich Chekin, the physical silver deficit over the last 5 years has reached 230 million ounces. That's 5 consecutive years of consuming more silver than was produced. Where did that 230 million ounces come from? Above-ground stockpiles, existing inventory, the freezer that's been feeding the market while production lagged. But now China's export controls have effectively said, "Our freezer is closed. You can't access our stockpiles anymore." And when one of the 2 largest stockpiles in the world goes offline, the remaining inventory becomes critically scarce. Skeptic argument number 1. China will ease the restrictions if prices get too high. They don't want to damage global trade relationships. Here's the rebuttal. China has been systematically tightening control over strategic minerals for years. They did it with rare earths. They did it with gallium and germanium. Now they're doing it with silver. This isn't a negotiation tactic. This is long-term strategic policy designed to ensure domestic industries have priority access while Western manufacturers scramble. And the proof: China elevated silver to strategically important commodity status in late 2025. That classification means silver is now treated like a national security asset, not a tradable commodity. Skeptic argument number 2. Other countries will just increase production to fill the gap. High prices incentivize new supply. This is where skeptics fundamentally misunderstand mining economics. It takes 7 to 10 years to bring a new silver discovery from exploration through permitting, financing, construction, and production. Even if companies started aggressive exploration today, new supply wouldn't hit the market until 2033 at the earliest. And here's the problem. Most silver comes as a byproduct of copper, zinc, and lead mining. You can't just increase silver production independently. You have to increase base metals mining, which has its own supply constraints and capital requirements. Skeptic argument number 3. Industrial users will substitute silver for cheaper materials. Demand will collapse. This argument ignores industrial chemistry. Silver is the most conductive metal on Earth. You cannot substitute it in high-performance applications without sacrificing efficiency. Solar panels require silver paste for optimal photovoltaic conversion. EVs need silver contacts for thermal management in fast-charging systems. 5G base stations depend on silver conductors for signal integrity. Yes, over a 10-year horizon, R&D might develop alternatives. In fact, Chinese solar manufacturers announced plans to reduce silver content in panels by 2030. But that's 4 years away. And in the meantime, demand is accelerating 15% annually, while supply is flat or declining. Here's what the bullion banks are really afraid of: the premium cascade. When physical silver trades at a 38% premium in Dubai, industrial buyers in other regions see that and think, if I can't source silver at spot prices, I need to lock in supply now before premiums widen further. So they start paying 10% premiums, then 15%, then 20%. And as premiums widen, more paper holders demand physical delivery, which tightens supply further, which widens premiums even more. It's a self-reinforcing feedback loop, and China's export controls just guaranteed it accelerates. Let me share my personal positioning based on China's export restrictions and the physical supply data I'm tracking. And I need to be very clear. This is not financial advice. This is what I'm doing with my own capital based on 12 years of watching these markets. I'm watching 5 specific triggers that will determine my actions over the next 60 days. Trigger number 1. If physical silver premiums in Asia exceed 40% over comex spot for more than 7 consecutive days, I'm going 100% physical holdings. Right now, Dubai premiums are at 38.3%. If that crosses 40% and holds for a week, it signals that the paper-physical disconnect is permanent and accelerating. At that point, I want zero exposure to ETFs that can cash settle, like SLV. I only want physical bars in allocated storage. Sprott Physical Silver Trust, PSLV, offers physical redemption coins in my personal safe. No paper promises, no synthetic derivatives, physical only. Trigger number 2, if China announces stricter enforcement or reduces the number of approved exporters below 40 companies, I'm adding 50% to my position immediately. Right now, 44 companies can export. If that number drops, if China revokes licenses or tightens requirements further, it means the supply choke point is getting tighter, not loosening. That's when I deploy additional capital into physical silver and quality mining stocks with zero Chinese exposure, US/Canadian operations only. Trigger number 3, if Tesla or another major manufacturer publicly announces production delays due to silver procurement, I'm rotating into call options on miners. Elon Musk's December 26 warning was a shot across the bow. If he or any other major CEO publicly states, "We're experiencing silver supply chain disruptions," it validates the industrial crisis thesis. At that point, I'm buying call options on Hecla, HL, First Majestic, AG, and Kerr, CDE, with 60-day expirations and strikes 20% out of the money. Trigger number 4, if silver lease rates exceed 6% annualized, I'm watching for a comex delivery crisis. Lease rates are currently 4.2%, already elevated. If they hit 6%, it means physical tightness is accelerating and banks are willing to pay extreme premiums just to borrow metal temporarily. Trigger number 5, if the U.S. adds silver to a Section 232 investigation, National Security Review, I'm preparing for domestic supply protectionism. Silver was added to the USGS critical minerals list in November 2025. That makes it eligible for a Section 232 investigation, which could result in tariffs on silver imports. If that investigation is announced, it means the U.S. is following China's playbook, restricting silver trade to prioritize domestic supply. At that point, I'm positioning for a bifurcated global market where U.S. silver trades at a premium to global prices.